Hi, this is Lawrence from financialthing.com, and I'm here today with Mike Bristow. He is with CrowdProperty. He is the CEO. A lot of talk in the peer-to-peer lending world about Lendy and the closure of massively impact defaulted loans that have led to the sort of downfall of that company. Lenders now have to be very wary about where they're putting their money, and the most asked question that I get is, how do they know whether a company is safe and to be trusted? What are your views on the Lendy situation, and how lenders can be better protected to where they're placing their money?
Yeah, I think it's a really important question, and it's shocking how retail lenders have lost money in these situations. We see our lenders and new lenders coming to us from other platforms asking better questions, asking about our expertise, asking about our due diligence processes, asking more about the data, asking us to point them in the direction of saying, well, okay, you're saying this data, but is anyone else validating that? And third-party validation is really, really important. Businesses like Bristow, who take every single loan cash flow, every loan, and comparably assess it. That kind of transparency and openness and attitude to being held to account for every loan that we offer, that's the kind of attitude you want to look for. But first and foremost, these businesses are not tech platforms. The tech is the enabler. The tech enables efficiency and enables tighter spreads to create a more efficient market. The absolute critical thing is asset class expertise. Do these people know exactly what the risks are, able to assess that and get better and better every day, based on, ideally, and in our case, absolutely the case, personal, hands-on experience? Our property director has 35 years. Rick's qualified, has built millions of square foot himself personally in residential and commercial property. He's put spades in the ground to find out, well, what am I going to find there? It's that level of expertise that gives you, the insight, the expertise, and then to build up that track record and then learn and learn and learn from that activity. My team get bored of me saying, you don't see Tiger Woods playing much tennis. And this is a mantra that we live to. We've absolute focus on what we're doing, get better and better every day, and that becomes world class.
Speaking about CrowdProperty as a business, you've said that you're based in Birmingham. Obviously it's a lot more cost effective to operate a business up there than say in central London, so obviously you're keeping that in mind. A lot of peer-to-peer companies are running in the red at the moment. What is CrowdProperty's future with regards to reaching profitability? Is that something that's expected in the short term, or is that sort of a long-term view? When do you expect to do that?
So first and foremost, yes. We're based in Birmingham, and I think that gives us a savings on our cost base of between 55 and 60% on a like-for-like basis. What we've done there is built a bigger, stronger team as a result. So our team is 32. About a third of that are property experts, about a third of that are tech developers building the more efficient platform for the future, and about a third of that is this other members of staff, investor relations and marketing, etc. And that built a more robust business. We're building to scale. So our current lending rate is broadly P&L break even. We are investing to grow. So if, for example, we took hey, look, we'll aim to grow 20 to 40% each year, then we could have a tighter cost base on staff or marketing expense, etc. But we're looking to double or greater each year. So we are investing in growth. So we could drop down to profitability right now. But what we're, that investment, for example, in our tech team, that's building an incredible platform. All of our platforms built in-house. It's all bespoke. It's all absolutely perfect for exactly what we want it to do on behalf of excellent lending in this market. And that will build a much more efficient business going forward. And we're making investments in various other sort of strategic positions in the market. So, for example, we're building a direct developer brand, which nobody else in the market has done, and that helps us also to more efficiently match the supply and demand of capital, which is a principle of the sector, and that can fundamentally make sure we continue to give a better deal to borrowers and better deals to lenders.
I've noticed some of the property companies that are doing property asset-backed loans are doing things in tranches, and sometimes they have trouble funding the second or third tranches of those loans. Does CrowdProperty tend to do things in single tranches, or do you do multiples?
We do it in tranches. It's very typical of the property development sector, not only peer-to-peer lenders, but the entire banking and non-bank lending world. It's done in tranches because that is the it's the cash flow spend of the developer. We have complementary sources of capital across our retail, high net worth, and a couple of institutions. So we are covered on those situations. So we're very it's actually a very good structure for us to phase those out, and we have that reliability of capital because it's not just one source of capital. And then the other factor there is from our retail crowd. Well, our projects are selling out in minutes, if not seconds, on our platform. It's actually a problem because we rarely have projects live on our platform because they're selling out so quickly. And the only way you do that is by working damn hard to build a trusted brand over many years of operation, which is delivered by very good lending and very good performance.
So do you have lenders that are having trouble actually investing their money because the loans are filling so fast?
Yeah, very much so. I mean, I had a phone call. One project went in 39 seconds on our platform, and the first phone call that came into the office was my mother saying I couldn't get into that one. So it's it's a problem. Again, we then very quickly we listened to the market. We very quickly implemented some pledge limits to enable more people to make sure they could get in and they could diversify. So we didn't want to skew people towards lumpier investments on that basis. And then very quickly after that, we also introduced Auto Invest, which we've been evolving to really help the people sort of smooth their investments and make it a bit less stressful, because it did become a bit like buying Ed Sheeran tickets for a bit, which is not a position that we want to do. We want to smooth that demand. But we're not just going to list more loans that sit outside of our comfort level. We have a set of criteria that we're very rigorous on, and that gets tighter and tighter. So we, whilst we are working hard to build that origination, build that direct to developer brand, because that's the best strategic channel, we will not list just because there's lender demand there.
So does the Auto Invest have some type of priority when going into these loan investments?
It gets an allocation of a project. It's a percentage-based allocation.
Okay. Talk to me also about loan originations. How do you find the loans? I noticed you said you don't use brokers and you source all the loans internally.
Yeah.
Why is that important?
Well, it's really important for two reasons. So firstly, on an economic basis, we took the attitude quite early on. We said, well, I'm going to run you through a very quick example. If someone maybe wants to make some investments, they may speak to an IFA. That IFA may say, put some money into a fund. That fund may say, I'm going to put an allocation of that fund into property. So put money into a property fund. That property fund will find brokers that will find property developers. Alternative finance is about, and especially peer-to-peer lending, is about the more efficient matching of supply and demand of capital. So the person whose capital that is, can it work harder for them? And if you take all of those participants out of that value chain, there's less cost in the value chain, and also each participant needs profit. So we basically have disrupted that entire piece to match directly. Now on the broker side, 95+% of the property market in the UK is brokered. Property finance market is brokered. We said because of our background, our knowledge, we're SME property professionals ourselves, we had various unique ways that we could build a direct-to-developer brand. So that means that we don't pay a broker. It means that a borrower doesn't pay a broker because both sides pay. Okay, so economically, that's good. Strategically, you're protected in case a bank is maybe short on its numbers 1 month and decides to pay the broker a little bit more. So strategically, we're protected there. But then there's underwriting richness. So we are building direct relationships with not only the whole borrower market, the developer market, but also each and every developer. We are speaking to them between 20 and 40 times each before a loan reaches our platform. And we're not only understanding the capabilities of that individual, that team, etc., and all of the risk factors around the project, but also on a human level, understanding the motivations of that person in delivering and executing that project. That is richer underwriting, and that's part of the ways we're building a better and better lending business than the best in the market.